Today, in this webinar, we are going to build upon what we studied in the previous session, namely the dividend discount model. Um, though I've named it advanced topics, there is really no new formula or breakthrough topic that I'm going to discuss. Rather, I will talk about a special case, uh, which is more real life oriented than the basic example that we covered in the previous session. In that version, we saw that the most generic form of the dividend discount model, uh, or the most common form of dividend policy in mature companies, is where the dividend grows at a constant rate, G, and the expected or required rate of return is constant over the holding period. Okay. So now, in real life, the situation, however, may be different. Companies may decide to pay lesser dividend, affecting G, which is the growth rate in dividend. Or some companies may decide not to pay any dividend altogether because because of tough business environment, or to allocate cash to some growth projects and thereby um, not pay dividends. Business cycle may be going through challenges requiring risks to cash flows, forcing a higher required rate of return. So therefore, value of R may change. Another case, one in which, or rather, another case which is far more common is the multi-stage model, where we consider that the company is growing at a higher rate in its initial years, after which it attains a certain maturity, leading to the tempered growth and finally settles down to a steady state growth. This is what we are going to deal today. Um, so this is the most basic form, or rather the most generic form of the dividend discount model that we studied in the previous session. Now, if we introduce growth, let's say growth is the growth rate, constant growth rate in dividends is G. So this is the formula that covers the value of the stock when you have a constant growth of in dividends, where you have R as the required rate of return. D1 is the dividend paid in the period one, that is the coming period, and G is the dividend growth rate, and with the caveat that R should be greater than G. So obviously, if the dividend growth rate is G, then you have the relationship between the current dividend and the next dividend is as follows: D1 equal to D0 times 1 plus G, and so on. And so this is a problem where you have dividends are growing at a constant rate of G. And then the special situation where there is no growth in dividends. For a zero growth situation, you have this is just like an annuity. So perpetual annuity. So P equal to D divided by R, where R is the required rate of return. So now let us see dividend discount model in real life. So again, we have P equal to D1 divided by R minus G, with these the definitions of the individual terms. But what if dividend growth is not constant? While most companies do maintain growth in dividends, the following exceptions may occur. So, as I said earlier, company may decide not to pay dividends in any year. Companies may reduce dividend in any given year, affecting G if the business cycle is not good, or the company may decide to pay increased dividends. Why does that happen? That happens because company may have a lot of cash, and really there aren't, in the company's opinion, it does not see any projects which are earnings accretive, or which can add value, and so they either decide to increase dividends and return the money to the shareholders, or do a buyback with the increased cash flow. And then in an inflationary business cycle, the expected rate of return may change. Okay, that depends on the interest rates. And so the expected rate of return, which is R, that may change. and the company may face certain constraints or certain challenging situations where investors who are wanting to invest in the company would require a higher expected rate of return. Okay, so thereby R may change. Okay, so we'll take the most common phase of a multi-stage dividend model. Companies in real life go through a sort of a growth in stages. So during the initial stage, they grow quite fast, after which they attain maturity and then settle down to a stable growth under normal business environment. So this is the diagram that exemplifies that particular situation. You have P0 is the current price, G1 is the growth rate in year one, G2 is the growth rate in dividends in year two, and then finally we have G as the constant growth rate in the stable period. Okay, so then you have PM. PM is the market price of the stock. Okay, and then you have R is the discount rate, which is the expected rate of return. And under these circumstances, what is the intrinsic price of the stock? So this is a problem that we are going to handle, or this is a problem that we are going to solve in this session, which will cover the multi-stage dividend growth model. So here is the problem definition in an Excel sheet where you have PM is the market price of the stock at T equal to 0. That is the current market price of the stock. And then you have in period 1, which is year 1, you have dividend paid is D1. In year 2, dividend paid is D2. And period 3 is basically the start of the steady state situation where you have dividend paid is 5 rupees. So 5 rupees, or rather the growth, sorry. So the growth in dividends is 5. So here, according to the given conditions, during the high growth stage, you have G1 equal to 15, which is 15% of growth in period 1. Then you have it moderates to 10% growth in the second period, and then you have 5% steady state growth. So now what we need to do, so R is 10%, okay, and then the dividend that was just given is 5 rupees. So now given these conditions, we need to find out what is the intrinsic price of the stock. So this we attempt this problem in this manner. So this diagram basically shows what is going on here. So 15% in period 1, then you have 10% in period 2, and then in the stable period we have 5%, and that goes on into the future. So and the dividend just given was 5 rupees. So if we apply 15% growth rate to 5 rupees, then we get 5.75. This is the dividend paid in period 1. Okay, similarly, 10% of this value so becomes 5.85. It's not really 10% of this value, but if we apply a 10% growth on this, it becomes 5.85. And then if we apply a 0.9. So what we get is that these are the dividends that are paid in period 1, that is year 1, year 2, and year 3 onwards. So now we consider this situation where you have in period 1, which is the high growth, which is where the dividend is growing by 15%, and then dividend per share is 5.75. Now, what we need to do is we need to bring this to present. So we need to calculate the present value of 5.75 given R equal to 10%. You see here R equal to 10%. So it's a simple scenario, or this formula we have already seen, the present value formula. And so the present value of 5.75 1 year, because this is period 1, is 5.23. Okay, here's what this is the equation. And then this, that is D2. D2 is 5.85. So what is 5.85 when you bring it to present? It becomes, mind you, there are 2 years now. So you have to apply the right formula. So it becomes 4.83. Okay, so the present value of 5.85 over 2 years, it becomes 4.83. Okay, and then you add these two present values. If you add these two present values, then you get 10.06. Okay, so this is a sum of the present values of both the dividends, of the dividends paid in period one as well as in period two. Okay, so this is the sum. Now, there is something else that you need to consider. So what you need to consider is, see, we know that the present value of an investment is equal to this present value or the sum of the present values of all cash flows received over the holding period. So now consider this period three. In period three, you have a 5% constant growth, okay, in dividends. So consider this to be the constant growth model of dividends, okay, in the dividend discount model. But for that, you need to find out what is P2, okay. So now, what is P2? P2, according to our formula, is given by P2 according to the formula is given by D3 divided by R minus G. You see, D3 divided by R minus G3. Okay, this formula we have already seen in the generic constant growth model. Okay, so for this period, we need to find out what is P2. So just by applying this formula, we can find out that P2 is 118. So P2 here is 118. Now what we need to do? We need to bring P2 to present. Okay, so that's a simple case. So we just calculate the present value of P2 over 2 years. Okay, so now if we do that, the present value becomes 97.52. Okay, so by according to this formula, it becomes 97.52. So what we have is we have the sum of the present values of the dividends brought to present, and then we have the present value of the terminal value of the stock. Okay, and then so we just if we add these two together, we get the present value of dividends plus the present value of the terminal value equal to 107.58. So this is the intrinsic price of the stock. So now you see the market price of the stock is 100, whereas the intrinsic price is more than that. So it's 107.58. So what does it tell me? That the stock is undervalued. Okay, so whereas it is selling for less than the intrinsic value of the stock. Okay, so then it's a good buy. Okay, now how much of a good buy relative to other stocks which are undervalued is we can find out by seeing the margin of safety. So if you have another equally good stock whose, let's say, the market price is 90 or market price is 80, so then you have a higher margin of safety. So that would be a more attractive stock to buy than this one. Okay, so that's how you apply the multi-stage model to evaluate valuation of stocks. Okay, so this is another simple yet very important real life example of the application of dividend discount model, or rather multi-stage dividend discount model. So that's the dividend discount model. Next session, we will consider the comparable companies and the multiples model.